Welcome to a CNBC Africa special, and we'll be looking at recapitalization of African economies. Now we have a distinguished panel of African experts who are going to help us tackle everything from informal sectors, FDIs into the continent, listing as well across various stock markets and the performance of those stock markets as well. Now, to be part of this conversation, you can tweet us at CNBC Africa or tweet me directly at the real Kwizera to be part of this conversation. Just introducing the panel of experts that we have with us today. We have Mr. Quinton Zunga. He's the CEO of RH Bofelo. Now, RH Bofelo just cross-listed on the Rwanda Stock Exchange as of last week. We also have Mr. Ntudi Moyelo, who is the coordinator at the Kigali International Finance Center, and Mr. Johnson Rukundo, who's a lecturer of economics at the University of Rwanda. Now, just to give us a little bit of context regarding the impact COVID-19 has had across various sectors, and most importantly, to focus on SMEs. I want to start with Mr. Johnson Rukundo, Dr. Johnson Rukundo to be more exact, who is a professor of economics at the University of Rwanda. Now, Dr. Johnson, quickly, if you could put an outline for us, what has been the impact of COVID-19 economically on the informal sector in the country?
Thank you so much for hosting us on CNBC, and thank you for taking your time. I would think the impact has been big and so much on the informal sector, specifically in the period of the lockdown. It affected many, especially the informal traders, the informal people in construction, the informal people in hotel, in tourism, in different kinds of sectors. They were affected hard, and these are the people who we categorize as a group of people who do not really have much on their side as savings, and they tend to be consuming every penny they land on, because most of the time they work on a daily basis and they are paid on a daily basis, or those who are lucky may even be paid on a weekly basis. But of course, remember, how much they are paid is less, and sometimes it is all taken into consumption. So I would agree, like the informal sector was hardly hit, and it's really important that some of the mechanisms should be outlined and set forward to make sure that at least something or a pandemic like this should not once again affect the informal people or informal employees. In other words, I'm trying to say, like, COVID-19 has given a lesson to most of the developing countries whose share of GDP is mainly contributed to by agriculture, but where employees are mainly in the informal sector.
Johnson, just to stay with you there, when you look across the region, East, South, West Africa, many of our budgets in these various regions have the Social Protection Fund. And this, when it came to it being used, it seemed in many of the countries we were not ready. Why weren't we ready?
We were not ready because of the design of most of these social protection settings that are available in different countries. Most of these social security projects, or let me call them policies, they only focus on people who are employed. That means the salary earners, and not the informal people. So informal people, informal employees, they just save on their own if they have the incentive to. And if there is no incentive, especially if I'm trying to say, if their income is less than what their needs are, then there is no incentive to save. Everything is taken for consumption. But when I come back to the policies on social security, social protection, they are more focused on salary. And remember, very few people have specific jobs that can earn them a salary, and at the same time there is a share of how much is paid by the employee and the employer as a social security. Secondly, these social security schemes are not even elaborative on the salaried employees, because in some countries you find that they focus only on retirement package, but not unexpected circumstances like the COVID-19. We would have expected most countries, like during the lockdown, social security to pay them either 20% or 30% of how much they contribute, so that they cover up their deficits in a COVID. But this was not the case. But this has opened up some of the countries' policy orientations, and they are starting to think about, well, we weren't on track. Now we should be changing and trying to make sure that we adapt with the incidences like these ones, where employees can be affected abruptly by a certain pandemic or a certain circumstance based on nature or something. So I don't think like we were there yet, and the policies tended to focus on only retirement, but social security should be extended beyond retirement.
Interesting views there. Quinton, I want to bring you into the conversation, and I just want us to start with your listing on the Rwanda on the Rwanda Stock Exchange recently. That's very interesting at a time when many companies don't seem to want to go out and expand. Now, is this a plan of trying to, recapitalize that company?
Yes, it is a plan to capitalize the company, but it's also a plan to diversify our shareholder base. I think what we are saying is that in the time of COVID, healthcare has become very high up in everyone's agenda. So for us as a company, we decided there was no need to slow down on our expansion, because right now everybody realizes the importance of healthcare. So we then had our secondary listing in Rwanda, which will allow the East African community to acquire or purchase shares in our company and invest in the healthcare of the region. As you probably are aware, we are now the only listed healthcare company in East Africa. So if you want to put your money in improving healthcare, you didn't have an avenue that you could in a transparent fashion. We are going to be the first opportunity for people who say, look, I want to invest in the healthcare of my nation or of my region, and I want to put money at work, get a return, but also do social good. So our listing is an opportunity for us to use the learnings from this COVID pandemic, in that we need to invest in our health, and we need to find vehicles and opportunities to invest in our health. And this is one of them. And we're excited that it has started a lot of debate. It has created opportunity. It has opened up a Southern to East African engagement around health. There's going to be so many things that we'll learn across the region, and we think it was absolutely the right thing to do, even in the pandemic.
Quinton, how do you get people like in the informal sector involved or see the opportunities that come with investment in stocks like yours?
So the key thing about the stock market is that it is a methodology for creating wealth, for investing, and for saving. But of course, it's structured and it's very formal. So the informal economy needs to tap into the platforms available to it from the stockbrokers in order to acquire these shares. Now, typically, what we recommend is that if you are a small investor, you would open a brokerage account with a broker and trade. But sometimes that becomes a lot cumbersome, and you can even invest as a collective, as a community. If you've got a community savings scheme, you can invest. Or we see banks offering trading platforms to individuals, which are available even on the phone. When you have a trading platform on the phone, you can buy your shares, buy your cell phone, and invest. So that level of market integration and development comes with the opportunity, because now when you want to invest in health, you say, now I want to invest in health, but I want to invest in something tradable, something transparent, and you can now get the market developing the various tools that needed for people on the street to invest. The key thing is to notice the stock exchange is not an exclusive opportunity for just professional investors. The public are the main drivers, and it's opened up for them quite significantly in the East African region and the continent alike.
Bringing in Mr. Nduti from Rwanda, Ntudi from the Kigali International Financial Center. Mr. Tudi, how do we get the informal sector involved in things like the stock market?
When you think about financial sectors and financial centers, one of the key questions that we have is around financial inclusion. So when we address that issue of financial inclusion, it of course also includes the informal sector. The question today is to see how to link the new technologies, especially fintech technology, that could be the link between the financial industry and the informal sector. So we can see as an example today, the use of mobile payment through phones. And the question is how this digital money can become a way of saving and a way of investment for the informal sector. Because the informal sector, of course, relate to the activities that are not registered today in the public domain. But they are still using the public infrastructure in order to be paid in today's economy. So what we want and what we believe, looking at a financial center like Rwanda, is how to attract more fintech companies for them to offer those solutions that will enable the financial inclusion of the informal sector. That's one aspect of it. The second one, again, looking at the way we have been developing Kigali International Financial Center, is how to create the policy framework that will make it possible for those men and women working hard in markets to be seen, to be known, and to be recognized by the financial sector. So one of the conclusions that we are having, looking at the current crisis, is the fact that the policies that we have today, for example, to have a company, may not be appropriate when dealing with the informal sector. Same-wise, how do you onboard someone from the informal sector into a bank? And here we are talking about the individual and not so much about the company. So those are the kind of issues that we are trying to address through our center. And we believe that the solution may not be only in the view of technology, but should be also addressed in a view of policy and products.
So are you saying that it's possible for us to look at the formal sector, which has largely been left out, as a viable means of recapitalizing our economies?
Yes, of course. Because as I was explaining, it is not because something is not registered or known into the current public registry that it is not trading, that it is not investing. The informal sector When we are going to the market to buy our fruits and so on, we could tomorrow put in place framework that will capture those transactions between people from the formal sector and people from the informal sector. So what I'm saying is the key question today is how to capture the existing trading and investment being made outside the formal sector. The question is not if the informal sector is rich or not rich. How many success stories have we heard about the lady selling fruits in the market and being able to pay the school of their kids thanks to savings that they kept under the bed? Those stories exist all across Africa. But the question is how the saving that was kept under the bed can become an investment into the stock. So how can a company like RH Bopelo actually benefit from it? And how can the expansion and how can the profit generated by the company also benefit from that into the informal sector? So yes, the answer to your question is there is money in the informal sector, but the problem today, we don't have the infrastructure to capture it.
Johnson, how realistic the views of Mr. Quinton and Mr. Ntudi when it comes to this group of people that, when on average 70% of them across sub-Saharan Africa are not even banked?
Their arguments and their propositions are relatively clear, and they could attract shareholdings in accessing finance, like they're saying. The only challenge I think that needs to be more understood would be how, in which way are they going to attract the informal sector into the financial inclusion? And what methods are they going to use? What are the incentives for these people? Tui has said, it's important that we note that some of the informal sector employees or operators who are into business at small scale or medium level, they are rich. But do they trust the financial institutions? Can they buy shares? Are they willing? Then there are different mechanisms we have to look at which can be applied. But probably one of the things that the companies listed need to look at is the cost of the share. Sometimes it's a totally excluding the informal sector or informal firms directly. For example, in Rwanda, informal employees earn 2,500, a casual worker who is working on a construction site. But then when we go back to the companies listed, how much is the share? Is it including, is it open so that the informal sector can also be part of it? That's the question that needs to be looked at on the other side. In other words, I'm trying to talk about the supply side and the demand side. Probably the informal employees and informal firms are willing to join. But what about the demand side? What are the financial institutions demanding? Those are the mechanisms that they need to look at. What is the trust level? Those are some of the issues we need to look at. Do they trust these financial institutions, or after 10 shares and 20 shares, then you are told you have less than 50, so you should be quitting, or someone else is buying your shares? Those are the challenges that need to be streamlined. But I also think the informal sector would also want to be part of the financial inclusion, especially if the incentive is to increase the multiplier effect.
Quinton, is it possible to include and to have the cost of shares allowing this group of people to be able to access investing in stocks such as RHB stocks?
Yes, it is possible. I think typically we would see that if the share price increases beyond a level that makes one single share difficult to acquire for the ordinary investor, a company can undertake a share split and ensure that the price is reasonably low for the individual investors. So that is a mechanism that's already there. Obviously, I think the companies need to make a concerted effort to increase their retail investors. And this is more a strategic issue that the company needs to be on the forefront of trying to diversify its shareholder base from institutional to retail. And I wouldn't say that every company does it. It is now dependent on whether the company feels it does need that small investor holding support or not. For us, we do need small investor holding because to take responsibility for their health. And the take responsibility for their health is when they actually put money in their mouth and the outcome has been you will. Okay.
We'll take a quick commercial break. After the break, we'll be talking about
Okay. So from the beginning. Okay. Yes, it is possible to include the individual investors in the shares of these listed companies. Currently, the mechanism that is available is the share split. A company can split its shares to a level that individuals can invest in that share if it becomes too expensive. But on a more strategic base, a company has to decide if it wants retail individual investors in its investor portfolio. That part is more around where the company feels it needs support from. And it is not for every company, but it can be done. For RH Bupilo, we want retail investors because we think when an investor puts money in their health, they are able to see the benefit of the social benefit of their capital being invested in their community. It makes them more responsible, it makes them more aware, and it's a way of making people realize the benefit of health. So individual investors are key to our investment thesis, and we will endeavor when we feel the its share price is too high to split the shares to allow individual and retail investors to participate.
Mr. Tudi, how do we include and create a business environment that allows these people to invest in these stocks?
I believe that first we have to understand what are the specific features around the way this part of the population is working today and is living today. So to come today and just give you an answer like this, I think I will be going out of my league. Number one, we have to understand that the main challenge that they are facing is that they are not recognized in those institutions that are creating the link with the stocks that you are talking about today. So if we take a step back and we look at the process in which we have to enter in order to invest in a stock. We will see that from the beginning, there is a barrier to entry for them when we look at the simple identification of who they are and what they are doing. So if we solve this first problem, to identify them so that they can be approved by those professionals that are in charge, let's say, of brokering to the stock market, it is already a first win. The second big step that I see is now how to get the transaction between them being recognized and the stock market. And we have to acknowledge that today, especially in Africa, ways to invest in the stock market in certain countries is still very standard, not to say it is still very manual. So how could someone who has very limited access to public utilities be able to invest in a stock if it doesn't have access to internet? So what I'm trying to explain is it is only through a step-by-step methodological approach that we can solve the problem.
Quentin, why is it important to companies, and you can use here, be more specific, use you as a company as an example, to diversify your shareholder base across sub-Saharan Africa?
Health has been underinvested across the continent. And when everyone thinks of health, they think of donors, international donors investing, but not in the government, but not themselves. So we see that the first thing is to get the continent investing in their own healthcare system and in their own community health to improve the health outcomes. So the diversification of shareholders for us is a means to say, let's get the whole of Africa participating in the health outcomes. Let's start talking together on a health-to-health basis. What do we mean? If we have facilities in Rwanda, we have facilities in South Africa, we are able to link up specific specializations that we can have together, as opposed if one entity wants to do it from one region of the country. So there is a lot of skill on the continent, but it's not been harnessed. So the way we create awareness for this opportunity, the way we create the drive and the economics is by having different investors. The second thing is, obviously we're trying to create, to have capital formation in health. So we want the East African region to also have capital formation in health, the Southern African region to have capital formation. Together, we will create a pool of funds that if we need to develop healthcare facilities, healthcare systems, we can do it together as Africans from different continents. It also allows the easier move of capital to where it's needed the most, and it presents a financial integration opportunity. So this diversification within an African countries means a lot of benefit and a lot of integration, and we think it's the right step to do for sub-Saharan Africa because it is the health investment is needed, and us as a company, we want to be the ones championing the cause of health, especially on the listed stock exchanges.
So are you saying that there is a very large untapped capital pool on the continent?
I think the continent is only discovering how much capital there is. And if you see the development of the capital markets and the wealth of the nations, they are linked. If you look at economies like Singapore, if you look at the economies like Hong Kong, that are small but have been able to present financial integration and financial instruments to foster savings and to foster growth. The economies have been growing. So we think within East Africa, there is a lot of savings, a lot of pension fund. Obviously, this is a relative discussion. We're not comparing ourselves to, to the New York Stock Exchange, or we're talking within our context that we are starting at a level that works for us. There are pension funds, there are insurance companies, there are retail investors. Those investors need to find a home of economic benefit to invest their money, and this is what we're tapping on. We're still obviously looking at our first capital raise, which is coming on later on this year, and we will be able to validate the capital capacity of these markets when that is concluded. But we are very confident that there is significant amount, and the number will keep on growing as more and more activity on the exchange happens, more and more financial instruments and innovations are developed. And that is the movement we want to tap into as a company.
Now, I want to start with you, Dr. Johnson, quickly. We want to bring in more FDIs into the African continent, but right now everyone is holding onto their cash. They don't want to bring in the money. How do we unlock that money to come into and help recapitalize a continent that is set to struggle post-COVID-19?
Before we think on recapitalization from FDI or through the FDI, I think most importantly now, African countries need to think about how to increase their own financing, because it's going to be difficult relying on foreign direct investments, especially that COVID-19 has been a pandemic that affected the whole world. So before they even think about coming to invest in our developing countries of Africa, specifically sub-Saharan Africa, then these countries are going to first recapitalize their own firms. You can see countries in Europe, in the US, they are trying to bail out most of the firms, enterprises, depending on the size, depending on how crucial they are, to make sure that they also stabilize. So it will take a few years before we think about the foreign direct investment again. Previously, before the pandemic, of course, most developing countries were starting to receive foreign direct investments, and you can have different examples from the south up to the north, from east to west. Investments were increasing, and the good thing about it is that as the investments increased, then it increased the employment levels of our people, and the capital accumulation was through our individual earnings, Africans earning from these companies, and also establishing some of the value chain companies alongside the main companies. So it's going to be slightly high, but what we need to do is now mobilize our own resources. I think, like Quinton is saying, that's a good initiative that they have listed a healthy company onto the London Capital Stock Exchange market, where they can raise their own funding resources. Then they can reinvest again into something else that can still be of value or importance through creation of employment opportunities. So we should think about starting as own investors within our continent, rather than thinking of foreign direct investment, because it's going to be a while, and I don't think it's going to be sustainable. So post-COVID is likely to be difficult, and it's already showing signs that foreign direct investment may not work.
Mr. Moyelo, you are part of the team that has the unenviable task of trying to bring in a bit of FDIs onto the continent. You are tasked with growing a new IFC in the heart of Rwanda. Now, how do you unlock that money and those funds into coming onto the continent?
Yes, I have this very ambitious and challenging task, together with colleagues from Rwanda Finance, to develop Kigali International Financial Center. So, FDIs, as the word say, foreign direct investment, is first of all an investment. So the question is how to create growth stories, because the investment are simply following growth stories that can be built in the continent. And what we are doing can be divided in three very basic silo, I would say, or three basic dimensions. Number one, when we talk about Africa, it is important to change the visibility of those growth stories that we have in the country. And this is in the heart of an international financial center, like the one that we want to build in Kigali today. Who will go out and who will talk the language of those investors that are looking for opportunities in the continent? Apart from a few places in East, West, and Central Africa, no such financial center is known and seen. What we are doing, we are creating an ecosystem where companies, businesses that are looking at the connection with investment can be known. What we are creating is an ecosystem where the investors can be closer to those opportunities in the continent. So that's in essence what we are building here in KIFC, the Kigali International Financial Center. The second element, the one was visibility. The second is validity, because one is to say that I need FDI, but you need FDI for what? You need FDI to develop something. You need FDI to pay another debt. This is where we have also a role to play, is to make it clear that when a project, when a company is within our ecosystem, the need for investment has been reviewed, has been assessed by professionals, so that we have that credibility. And of course, the third one who is coming after this is the voice. Africa needs to have a voice saying we have the professionals, we have the technology, we have the knowledge, we have the compliant system and ecosystem, we have the regulators that will make those FDIs secured in our continent. So again, looking at the statistics, FDIs are mainly going to two types of countries: the one with the growth stories and the one who are able to aggregate and put together growth stories. And in the case of Rwanda, we can see that vision to actually play in both sides, being a country of growth and being a country where investors and those who need investment can meet and can do business together.
They're bringing you in, Johnson. What are the sectors that need, crucial sectors that need investment or need to attract investment on the continent?
There are a few sectors that we need to focus on. One of the challenges of most developing countries in Africa has been focusing, trying to tackle each and every sector, and not being specific on which sector should drive the others. I think we need to focus on agriculture, because this is the backbone. When you try to move people out of agriculture, when it's been their activity for more than 100 years or 60 years back, it's totally difficult for them to transform. So we need at least to make sure that we improve so that when people improve their agriculture, then it's a way of providing raw materials for some of the industries or processing industries. So we can start from the processing industries. But for example, we cannot jump from agriculture. You cannot even process tinned beans and then you start manufacturing vehicles. what will be the market? What will be the purchasing power of the people to buy brand new cars in Africa? So those are some of the sectors that we need to look at. Agriculture, then look at education, and look at health. When I talk about education, I'm trying to look at the quality of education. When I talk about health, it is a social aspect that needs to be looked at so that we facilitate people to be in their farms, so that people are not worried about the insurance, so that people have a future in whatever they are doing. Then we also need to focus and develop infrastructure. Of course, there are other cross-cutting sectors like technology. In all that, we need technology. We need to start looking at how students can study online. We need technology to increase the financial financial values and investments through online by having information, because technology is one of the key to provide such information, updated information on which financial sectors, on which financial institutions are performing very well, and the daily levels of sales on the stock exchange or on capital markets, We also need to think about sectors that are probably not important to every country, but where each country has a comparative advantage. For example, in tourism. So some of those sectors, but we don't need to look at many sectors without taking a comparative advantage of which one we should focus on. Most countries spend a lot on security, but in this era, it's not a priority. But it should be that we transfer the money from the security then onto other sectors, which are beneficial to all other, to the majority of the population. So I think mainly we need to look at investment in agriculture to increase productivity output, then investment in education, investment in health, and investment in infrastructure so that people have access to electricity, safe and clean water, so that at least we have 80% feeling safe.
I can just add on there.
Johnson, feels like we need investment in everything. Quinton, I know you have a bias towards the health sector, but what other key sectors do we really need to focus on in order to enable our economies bounce back post-COVID-19?
I think primary sectors are a key advantage for the continent because we do produce a lot of primary goods. So beneficiating our primary goods is a very important step. We produce a lot of minerals, and all we do is send them somewhere else and they come back as products. But if you look at beneficiation, you would have to also say the impact areas that have been mentioned: health, education, water and sanitation. Those are industries that can become good job creators, good investment vehicles, and create an impact for society. So I think a combination of infrastructure development, beneficiation, and looking at each competitive advantage that we have and maximizing the return profile is what Africa should do. I definitely think Africa can do a lot more if we have the confidence and the trust of the investor community, institutional and retail. And we need to develop that level of entrepreneurship and company development to move to the next level, which will allow the economies to grow and start producing more. Right now, I think Africa is a big net importer of manufactured goods, which shouldn't be the case. We've got a big continent of over 1 billion people, and we are not taking advantage of that aspect. I think, lastly, I would say all intra-Africa investment is also a new frontier. I think looking to the West and the East has always been what we look at, but now we have to look within ourselves, within the continent, of what can we do in order to know to develop the continent together. Most African travelers would actually know a lot more of Western countries or Eastern countries than they would of their own African economies. And if you look at the developmental of air traffic routes, you find that most of them are not intra-Africa as they should be. So we've got a lot of work to harness the potential that we actually have. We have a thriving young population, growing middle class, and there's so much we can do if we start harnessing that together and working to develop our economies.
Quinton, if I just stay with you and this also and your parting remarks right about now, you touched a sensitive topic, and I call it sensitive because it's one that we have been uncomfortable to talk about when we reflect as economies on the continent, and that's something to deal with capital outflow. Reports coming out say more than $100 billion US leaves the continent in some way or another, waivers for taxes by various governments. How do we solve that issue? And how do we enable that this money at least goes into some form of intra-Africa investment?
The first thing is trust and compliance, and it is important for us to realize that to maintain the investment flows, you've got to create the vehicles that investors can invest in, whether it be individuals or institutions. If you don't have them, that money will flow outside to other economies, develop other economies, but it should develop the continent. So this is the main driver for development of the capital markets, development of investment instruments, financial education, and all of those. We think there is a lot more that can be done within Africa. Traditionally, the stock exchanges were not an avenue that everyone would look to. Everyone would look to invest in properties, so they will bid up the prices of properties, or in cash, or under the pillow, or take it offshore. We think this new age Africa, this new continent we're developing, can do a lot more, and capital should be attracted back to Africa to develop the continent as opposed to leave, which has been the case. So I'm very hopeful that the endeavors of our company and other companies to show that within the continent we can work together are going to lead to a lot more opportunities of trust and development that can see more money attracted into the continent than leaving. For instance, if you wanted to invest in healthcare, before you'd either have to buy your own hospital, which is too big, or look for investment opportunity elsewhere. But now within the continent, you have an opportunity to invest in healthcare, and you can do it right in your own country. And that's the kind of development I think is going to be very helpful for the continent.
Thank you very much there, Quinton. Mr. Moyelo, how do we stop, the capital flight?
What we see today is, number one, in some countries, a lack of political willingness to stop it. We have to call, I will say, a cat, okay? If we want to stop the outflow of capital, first, we need to make a decision that we want to stop it. If we want to stop it, number one, we must put in place the relevant policies to protect our local economy and make sure that that outflow of capital is happening only when it is justified. But this cannot be done only at the level of the policymakers. When we look at a financial center like the one that is being built here in Kigali, it goes down to education. Education of those that will actually execute the transactions. Why is it that a banker in one of our African states will approve a transfer of 20 million without any supporting documents? It is a matter of skills, capacity. We need to invest more in those professionals that are in charge of executing those transactions. Number two, the second layer, our regulators, those that are supposed to control the transaction. We have to invest so that they have the tools to enforce the laws and regulations that have been decided at the higher levels. And it is only looking at those three layers that something can be done. But of course, and here I'm looking at my experience in places like Singapore and Luxembourg. If I don't see any action taken against me when I'm transferring my millions outside the country, why would you want me to stop? So enforcement of law is important, and this is why those type of transactions should be in a way criminalized. And when we are building the center here, again, I repeat myself, we are making sure that those compliance to international standards are being implemented. There is no secret. If you want something, number one, you must take a clear decision that it is what you want. Number two, you must give yourself the means and the tools to do it. And in our case, it is important that those transactions, when they are flagged, that there is a voice saying to everyone that it is not acceptable. And if you allow me to go back a little bit on the first subject about the FDIs. Yes, we want to attract more FDIs, but I would like to see that study where FDIs will be compared to the outflow from the continent. From what I have seen, offshore centers are receiving more capital from Africa than any other continent, which lead me to a second subject. Why will someone send his money out? It is true, tax may be one of the reasons, but maybe we are missing in our continent opportunities for investment. When I say opportunities, we have plenty of them. But remember what we said. Are those opportunities being seen as secured? Are those opportunities being presented in a way an investor will be comfortable? So this has to be addressed, and the development of the capital markets could be an answer to it.
Unfortunately, Mr. Moyelo, I just have to cut you short. This conversation seems like to have just started, and I'm sure we'll make more time for it going forward. And, you know, as they say, all good things come to an end. Thank you, gentlemen, for making the time to have this conversation on recapitalizing African economies post-COVID-19. There we had Dr. Johnson Rukundo from the University of Rwanda School of Economics. We also had Mr. Ntudi Moyelo, the coordinator of the Kigali International Finance Center, and Mr. Quinton Zunga, the CEO of RH Bopelo, that I've just listed on the Rwandan Stock Exchange as well. Now, to be part of this conversation or to have any comments, please tweet us at CNBC Africa, or you can tweet me directly at The Real Kwizera. Have a blessed day.